Okay, good morning and welcome to our Tuesday Market Outlook session. Today, I will be walking you through how we are viewing the current markets. And we have seen some encouraging price action here in the major indices in the last couple of days, with key levels remaining intact so far. Volatility is showing signs of reversing lower after remaining fairly elevated for almost 2 weeks. And that's a huge plus for equities. And the early information regarding the new variant seems that patients only experience mild symptoms. So this translates to the fact that there will be less pressure on governments to enact lockdowns and travel restrictions in the future. And it definitely paints a more positive outlook to what we've had in the last couple of weeks or so. So quite a lot to get through today. Before we get started, just a quick disclaimer. The types of securities forms and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. So our agenda for today, we will be starting off with the major indices. As per usual, we'll be highlighting some key levels, going over some technicals to get a better idea of market direction. And especially now with the major indices pulling back, it does provide a more attractive opportunity here, in my opinion. And we will get to that in a second. From there, we'll be moving on to fixed income and commodities. We are seeing early signs of a shift in risk sentiment, and that is impacting bonds and yields. From there, we'll be taking a look at the sector rotational model. There's definitely evidence of broadening participation, broadening leadership as well, compared to what we had before, with technology being the sole sector providing leadership. So definitely an interesting take on the sector rotational model this morning. From there, we'll be taking a look at some subsectors of interest, and we'll be ending today's session with some bullish and bearish market observations. My name is Prakash Vijayanath. I am an analyst here at OptionsPlay, and today I am really excited to share with you our thoughts and analysis on the current market. So starting off with the S&P 500, we have seen a pullback here to the 453 support level. And this was a level we have highlighted multiple times and emphasized multiple times for a number of weeks now. And what I find to be very encouraging is a bullish price action that we are seeing at this level. So we saw initially that a strong rally all the way to around that 470 area of resistance. Multiple times the S&P 500 failed to break above that level and did move lower all the way to 453 here or so. What was concerning, I think, was last week Wednesday, where price did breach that level, but Thursday, the next day, it immediately closed above that level. And price is maintaining to stay above this level. Now, obviously, we can see here, pre-market, it's set to open significantly higher. So overall, a very encouraging picture here for the S&P 500, especially when you look at the fact that momentum as well is starting to pick up. And, while there is still some uncertainty regarding the new variant, it does look like markets are shrugging that to the side for now, waiting for more information and essentially resuming the sentiment that they were at before the this news of this new variant here. And that was a very bullish sentiment here leading into the year end. So I do expect a continuation here of this rally back to that 470 resistance level. And we may even see a breakout on strong momentum above that level and a continuation higher here for the S&P 500. NASDAQ 100, similar price action here. We can see the NASDAQ 100 rallied all the way almost to 410, since then declined all the way back to the 382 key level, which was a previous swing high. And over the last 2 trading sessions, it breached that level and it did bounce higher here. So very encouraging to see that price is maintaining to stay above that level. And obviously you have that move this morning, very sizable move expected at the open for the NASDAQ 100. And that does paint a positive picture for a continuation of the rally back to that initial 400 minor area of resistance and possibly even higher here on strong momentum, especially when you consider the fact that momentum is on the more oversold side right now. So definitely more room for improvement here for the NASDAQ 100. And I will say, I do think the NASDAQ 100 has a potential to outperform the S&P 500. And that leads me to my next graph here for growth versus value. So early November, we saw growth outperforming value here, right? We saw it relative in the weekly chart. And even here on the daily chart, we saw that strong outperformance here. And since then, in the last couple of weeks, we have seen a shift in sentiment to a more risk-off sentiment. Investors were a little bit spooked about the new variant and were rotating out of the higher growth names and into more safer value names. And we can see that over in the last couple of weeks, there was that strength here in value. But even yesterday, there's been a shift. There's been a change in sentiment here. We can see it's shown in the major indices. We've seen strong movement this morning, and I do think that'll be translated here to growth outperforming value in the next couple of days or weeks or so. So again, very important to be made aware of that higher growth more of the growth names do have potential here to continue higher and are back in the driving seat. So I will say price action today will give a better indication of whether that there is more outperformance expected, but based on yesterday's price action and based on the moves this morning, for not only the US indices, but even European indices, I do think there is a good case here to build for growth relative to value to continue to outperform. So taking a look at small caps, and a very interesting chart that we have here. We saw that break above that 233 level finally a few weeks ago, all the way to 244, where it did run into some resistance and such a sharp move lower within a matter of weeks, all the way back to that major support level at 213. Now, obviously, very encouraging to see that bounce at a support level with good momentum. And obviously, this gap up here, all the way to 222 this morning, paints a very positive picture for a rebound here, for a reversal higher here in small caps. And the initial target that you want to be looking at would be that 233 major resistance level. The big question here is whether it'll be able to break above that level, or is it just going to fall back into the sideways range that it's been experiencing for almost a year now. So a bit of patience is required to see just how much momentum small caps carry to that major resistance level. But ideally, we would like to see that break above, maybe a retest, and that provides a good risk to reward move higher here for 244. But where price is currently at, very positive, very bullish price action. And I do think that a move back to the 233 level is definitely on the cards here for small caps. Okay, so taking a look at the VIX, we are seeing that decline in volatility, which is great for equities. And while volatility was at its highest level since late January this year, it did not really stay above that 30 level that you can see here. It didn't really stay above that level for too long. So, and if you take a look at the weekly charts, and with the exception of the pandemic drop, which caused the volatility to skyrocket, we haven't really experienced more than 2 weekly candles of high volatility. Every time there's been one weekly candle of high volatility, immediately turns lower. One weekly candle of high volatility and immediately turns lower here. And we've already experienced 2 candles of weekly, 2 weekly green candles here of high volatility, and we've already seen that move lower here early in the week. So that, for me, provides good evidence that maybe volatility is starting to shift lower all the way back to where it was before the new variants, the news on the new variants came out. And again, very positive for equities. We know high volatility, the S&P 500 tends to perform very poorly. It starts to decline. Lower volatility conditions provides a more bullish case here for the S&P 500. But it's good to see the fact that volatility is starting to move lower here and move lower very quickly. So taking a look at bonds, and again, some very interesting price action. So we highlighted this 155 level last week during our Tuesday market outlook session, as well as a rapid fire session, right? Where we saw the break above the 151. But what was surprising was just how quickly price reached the 155 level. And it was an immediate rejection there. So immediate rejection on Friday and a strong move lower yesterday. And I do think there is some evidence here of a break below that 151 level again and a continuation lower. Because you have to remember, bonds are going to be more Fed driven for the next few months. And with a more hawkish Fed, as well as a shift away from the risk-off sentiment, we may be seeing weakness here in bonds. So the key level here is 151, which was a previous resistance level, and a break below that level could see price move all the way down to 146. And if that level breaks, the next support is all the way at 141. But the outlook in bonds has definitely shifted to a more bearish one because, again, risk sentiment is now shifting to a more risk-on sentiment. So the demand in bonds will naturally drop, and that should mean that yields should move higher here as bonds drop. And we can see here there was that move to 137 basis points. It actually reached 135 basis points on Friday, but since then a good bounce higher so far. When it comes to yields, it does look like we just have to wait and see whether yields can make a very quick bounce higher here with good momentum, or whether it'll just continue to consolidate at the current levels. But higher yields is definitely a big plus for banks, which have been severely underperforming the broader markets in the recent weeks. And lower yields is obviously a bit of a headwind for banks. And should yields break above that 137 basis point level, the next key level here is 115 or so, but I don't really see a case for yields breaking below this level. My bias is more shifted to the upside here for yields. In taking a look at the US dollar index, so obviously, yes, very bullish. And we have to remember we have a more hawkish Fed now. They do not view inflation as transitory, and I quote, they are retiring the T word. So definitely a very hawkish statement or hawkish stance by the Fed here. And we can see that, dollar has been very bullish. Since a few months ago, since early September, it's rallied all the way from 92 to just about 97. And now it is experiencing a bit of a pullback. It is definitely near overbought conditions, and momentum has definitely slowed. And I will say what's a little bit concerning for in the short term for this dollar rally is the fact that in the last five bullish days, price still hasn't broken above the range of the last bearish candle. And that does speak to the lack of momentum in the dollar right now. I don't view this as bearish by any means, but right now I do think that the dollar is in store for some consolidation, with support at the 95.50 level where it did bounce higher on two previous occasions. Now, longer term outlook for the dollar is definitely bullish. You have to remember the dollar is compared against a basket of other currencies, with the euro carrying the most weighting. And right now, the eurozone, they're in no position to raise rates. So I do think that the longer term outlook here for the dollar is a continuation of this rally that we have seen in the last few months. But right now, you can definitely see just a lack of momentum. And I wouldn't be surprised, a bit more sideways movement here for the dollar before we see that bounce higher, that breakout higher above 97. Taking a look at gold. So gold moves inversely to the dollar. You also have to remember gold, yes, it's an inflation hedge, but a long-term inflation hedge, not a short-term inflation hedge. Now, the Fed are focused on tackling inflation. And I don't think that paints a very bullish picture here for gold, especially with the dollar being as strong as it is. We have this very strong move to the downside, a break below 167. And we saw a bit of a retest of that 169 level, back to that area between the 21 and 55-day exponential moving average. But it did move lower with strong momentum on that day. Overall, the outlook here is bearish, but I wouldn't be surprised if it was more a grind lower instead of just a straight move lower. And when it comes to the key levels to be made aware of, I think the big one would be the 161 level. That did provide support on multiple occasions. If we take a look at the weekly chart, but I think it might be more of a grind lower than a straight drop lower here, especially with the dollar looking like it's entering a consolidation range right now, at least for the short term. Taking a look at oil. Oil has seen some crazy volatility in the last few days. We saw that huge drop from 78 to 68, and that was because investors were spooked from the new variant, from potential lockdowns and a severe contraction in demand. And price did reach around the 62 level. I know it's difficult to see the tail of that candle because of the volume bar, but it did reach that 62 level and actually bounced high from that level with decent momentum. And we can see here the momentum has continued so far, and oil does seem to be making a very sharp recovery after getting spooked at around 78 a couple of days ago. And again, that speaks to the fact that investors are shifting the risks of the new variant to the side for a bit, and are really focusing on the data that they have now, and are essentially waiting to hear any bad news about the new variant before really, shifting to the risk-off sentiment again. But definitely a recovery here in crude, and I wouldn't be surprised if we see the 75 level in a couple of days or so. Should that level break, 78 will be the next minor level, and again, 84 would be the next key level of resistance in a couple of weeks should this rally continue. So taking a look at some sectors. Last week, we had around 8 sectors with bullish trends. This week, that has changed. We now have 6 sectors with bullish trends. I do think that'll change based on the price action over the last couple of days. I do think the trends will change in the next few days. But definitely that speaks to the fact that, there was a broader market sell-off for the last couple of weeks, and that did impact the broader market here, as you can see multiple sectors turning into bearish or neutral trends.
Hey there, thank you so much for watching. I really hope that you enjoyed today's session. If you want to watch the full recording and all of the market mover symbols that I covered today, register for an account at OptionsPlay.com. You will access my daily trading signals to follow along and weekly options education sessions to improve your trading skills, and gain full access to our platform to analyze the risks, rewards, and probabilities for any trade. Regardless of where your ideas originated from, filter them out with OptionsPlay and start gaining confidence in your trades with our platform. And the best part is that you can start completely free with a 30-day trial. Click on the link in the description below to learn more. And as always, have a great trading day.